account and deduct all your non-operating income which is being credited, non-operating item which is credited in your account. So here you can see there are few items are being deducted in your operating activity. One is depreciation around 7,400. It has been added because it is a non-operating item debited. Then gain on sale of investment. This is income. This is on the credit side, so it is deducted. Then loss on plant of asset around 600. Then interest on expense 4,600. And interest on income, it is an income. So that is why it has been given as 1,200 deducted. And apart from that, any increase in assets and liabilities you need to adjust. You can see in the question, if you see, operating expense you leave, what it is given, along with that all your non-operating items to be deducted. So you can see here interest expense paid. So 4,600. So what already it is being debited in your P&L account. That is why it is shown in the statement. So what you have to do in your operating activity, which is you are getting 4,600, in that you will add this item 4,600 as a non-operating item. Then interest income credited, received. So this is a non-operating income. Interest, it is not connected to your business. So it is an income from the interest you are getting as a source of income. So that you can, it is an income you need to deduct in your operating profit. So, and gain from sale, this is also you will minus from your profit. So when you see in your operating profit, loss on sale of plant, here it is minus. But when you do a cash flow, which means how much inflow and outflow is there, that is what we want to do. So when you prepare cash inflow and outflow, at the end, if you see in your balance sheet, it will be given opening cash balance and closing. When you complete that cash flow statement, you will get exactly what is there in your balance sheet cash balance, that amount you will get, which means you have recorded correctly. So here loss on sale of plant, it is given as 600. So that you are adding. So if you see here, I think you can understand now. So 4,600 is our profit. Then 2,400 gain, a non-operating, which is already credited. So you need to minus. And loss on sale, you are adding. Interest on expense, you are adding. Income, you are deducting. Apart from that, any other changes in your working capital, that you can do the adjustments in your operating item. So here you can see the first one is trade receiver. What are the item decreased in your balance sheet in your current asset? There is a decrease in your trade receivable. There is decrease in your prepaid expense. Then there is an increase in inventory and increase in trade payable and increase in outstanding liability is given. Correct. So any increase in a asset you will minus. Correct. And you can see the format. What in the format it is given. You can see add increase in current liability, decrease in current asset. Correct. Then at the same time you will minus increase in current asset and decrease in current liability. So this is the items, changes in the working capital you will do in your operating income. So you can see in the question, what are the item we have deducted? The trade receivable. First you can see trade receivable. Earlier it was 11,000 and now it is 9,400. So it means there is a decrease in trade payable. So what is the asset have decreased? So when asset is decreasing, what you do? There is a decrease in asset, you add, right? And the same way, prepaid expense. Earlier it was 1,000 rupee and now it is 200 rupee. So there is a decrease in the asset, so you are adding. So likewise, so here what are the item you considered? One is cash. The second one is prepaid, not cash. Cash is the last. When you close this, you can see here the cash balance is 9,000, 3,000. When you close, you get the same value. So prepaid expenses you will record, then you record inventory, then you record trade payables. Yes. So then trade receivable and trade payable. So what changes happen, whether there is increase or decrease, accordingly we will do. So now see here, the first one is inventory. Earlier the inventory was 22,000 and in the current year, that is in 21, it was 28,800. So what happened, there is an increase in the inventory. So in operating, there is, you can see increase in inventory. What you have done, when there is increase in the current asset, you will minus. When there is a decrease in the current asset, current liability, you minus it. Always keep this formula in your memory. You can note down somewhere and keep. Increase, what you will add is when there is increase in current liability and decrease in current asset, which means there is inflow. When your liability is increasing, you are borrowing more loan, means what? There is inflow. The money is coming inside. That's why you are adding. Decrease in current asset, which means you are reducing your current asset. Asset is going out and the cash is coming inside. So there is an inflow. So you are adding. Likewise, when you will minus, there is increase in current asset. Even though it is an asset for a business, but when it comes as a cash flow, when asset is increasing, your cash is going out. So you are minusing. At the same time, in a decrease in current liability. When your liability, when you are paying off, the money is going out. So that is the reason when there is outflow, you deduct. When there is inflow, you add. Okay, are you getting it what I am explaining? Yeah. So here you can see that is the reason there is an increase in trade payable and increase in outstanding, all added except increase in inventory. Rest all it's been added. Only the increase in inventory has been deducted. So now income tax, any income tax paid you deduct. So what you get is your operating activity, which is 9,400. Now in that cash flow from investing activity. In investing activity, what you record, only the purchase of purchase of all your assets, sale of all your assets you record. Now you can see here in the adjustment it is given. There is a purchase of plant, sale of plant, purchase of investment, sale of investment and interest have been received. So you can see here, there is a purchase of investment 15,600. Sale of investment, there is 2,400. So you can see here the purchase of plant 24,000, the cash is going, and sale of purchase of investment, that also 15,600, which is outflow of money, and sale of plant 1,000 rupee. So you can see here the sold plant cost of 2,000 with accumulated depreciation rupees is 400 for 1,000 rupees. So there is an inflow of cash. So these things are being added, sale of plant, sale of investment, and what you get is your investing activity. Then here next comes is financing activity. So any financing activity like share, issue of share, repayments, interest paid, dividend paid, this all. So outflow all connected to that you are minusing here in the question, and whatever inflow, here you can see there is increase of share, inflow is there. So where it is increased, issued 3,000 rupee, share of 10 each. So you can see here there is a proceeds of issue of share capital of 3,000. So likewise paid cash dividend 1,600. There is an outflow. Repaid 10,000 bonds of face value. So these all are the outflow of money. So you are you can see here repayment of bonds all. So this all are being deducted. And then what you get is your cash outflow. So you can see here it is coming around 9,200. So when you see in your balance sheet, actually it should have the same value. See here 9,400. So this is the, when you prepare in your balance sheet, when you prepare a financial statement, you have recorded 9,400. At the same time, when you prepare a cash flow item, it should be 9,400. It should be 9,400. Sorry, 9,200. 9,200. And here also in your calculation, if you see, it is coming around 9,000. So which means all the items are recorded. So your balance sheet statement, it is supporting with your cash flow statement. It gives you the correct cash inflow balance. So it helps us to study how much inflow and outflow have taken place. Hope you understood the cash flow statement, right? Next. So here also we are continuing with cash flow statement only. So cash flow statement, I think we have given an introduction of cash flow as per accounting standard we are preparing. So cash flow, what are the features of cash flow statement? So cash flow statement is a periodic statement. So it is a statement of changes in financial position of cash basis. On cash basis, you can understand what is the changes happened, what is the movement of cash over the period with two different dates. You can understand, you can take decision on that. So it also show inflow outflow of cash and cash equivalents from various activity, and also it also provide information about inflow and outflow. That is the main purpose of cash flow statement. So here the data what is used for cash flow statement is, first of course you need profit and loss account, where you use profit and loss account for studying your operating activity. You need balance sheet where you have liability and asset, which will be used for studying your financing activity and then investing activity. So what are the objectives of cash flow statement? So it helps to make a financial policy and to identify where the major expenses are incurred, and also to find what is the net cash inflow and outflow, and it can help to predict the financial strength of the company. Even at the time of liquidating, it can understand how far the company is in a position to pay off all the debts. So what are the benefits of having a cash flow statement is, highlights the liquidity position of a company. It shows it can understand what is my current cash position, current cash status. So it helps us to study about the liquidity of the company, and also it helps to helps in cash management. So with the cash flow statement, the company can estimate what is the future cash receipts and payments. So that is easy way for a company to plan for a future, to understand the liquidity or to do any investment. So it helps the management to know where the company stands and maintain optimal cash balance. So if it also helps to identify where the fund has been stuck, where there is a less fund, where there is an excess fund of fund is there. So this easily we can study and compare it, comparability. So cash flow statement will help us to study the transaction of both previous and the current, and inflow and outflow, indicates the future. So it is one of the indicator about to study about the past assessment as well as also the future. So cash equivalent means it is which you can easily convertible into a cash within a short time. So there are types of activity cash flow statement. One is operating activity, second one is investing activity, third one is a financing activity. So as we discussed in the operating activity, all your operational transaction, non-operating items, all your manufacturing, selling, all these items can be added. So here there are two methods are there, direct and indirect. Previously we saw was indirect method. So here cash flow method to identify cash from operating item, cash inflow from operating activity. So here cash receipts from sale of goods and cash receipts from royalty, fees, commission, other revenues are considered as inflow, and outflow of operating items are cash payment to supplier, cash payment to employee, or cash payments for insurance premium, any cash payments for income tax, all these are outflow of the item. So cash from investing activity, you can see here your purchase of any long-term assets, sale of any long-term assets, fixed assets, this all will come under investing activity. So cash inflow of investing activity are disposal of fixed asset, including intangible assets. So when you dispose asset, there is an inflow of cash. Asset is going out and cash is coming out, coming in. Then cash receipt from disposal of intangible asset. So any cash received on repayment of advance or loan from made to the third party. Then any dividend received from investment, any interest you received from loans and advances. So this all are your investing activity. Cash outflow of investing activity is you buy a fixed asset. Okay, you invested in some asset, then there is an outflow of cash. Yes. Then any cash payment for futures, options, or anything which you make payment, then that comes under outflow of investing activity. And then third is financing activity. Here any issue of shares, any issue of debentures, bonds, or any short term, anything connected to that, that will come under inflow. So which will come under financing activity. And at the same time, what are the outflow of financing activity are repayments, repayments of loan, interest paid, dividend paid. So this all are cash which is going out, which will be considered as non-cash item. Then preparation of cash flow statement. So here you can see these are the major things. Cash flow from operating item. Under that there are various subcategories, and cash flow from investing item, cash flow from financing item, you are adding all together. And the cash flow, what cash, opening cash or the cash what you have at the beginning you can add. So what you get will be your closing cash. Okay. So this is a direct method. The sample is given. So cash receipts from the cash collected from debtor. How will you identify? It is a credit sale. So decrease in the account receivable minus increase in the account. So best way is always, I will recommend you can go for indirect method. So that will be even more better for you to understand. So cash receipt from customer. So minus cash paid to supplier. That is your cash generated from operation. Any income tax you paid, then you get your at last the cash flow, that is net operating item. This is your indirect method which we studied in the previous unit. So in indirect method, first you will have your net profit. You are finding operating item. For that you have net profit. In that you add non-cash item or non-operating item which is already debited. So here you can see what are the item added is depreciation, goodwill, any provision of tax, preliminary expense, loss on sale of investment, and you minus all your non-cash or non-operating item which has been credited. So those all you can deduct. And then apart from that, any increase in current liability, any decrease in current asset, you can add, and you can minus increase in current asset, decrease in current liability, and minus the tax. So this is one part. When you do everything, you get cash from operating activity. Okay. So this is what they have done. So here you can see here, from the following information, calculate the net cash flow from operating activity for the year end 31st March using direct method. So only direct method. So which means what? Anything inflow, outflow you record. No non-operating items you will never record here. You can see here what are the item inflow. What are the inflow you have? You can see here cash sale. Cash sales 1,50,000, and then receivable collection 1,50,000. So totally my receipt is 3 lakh rupee. In this what all cash outflow goes, that you need to deduct. So here it is given cash purchase 35,000. Yeah. You can see here cash purchase 35,000, and yeah, credit purchase will not come because it is not in cash. So anything connected to cash only we can record. Then payment to creditor. So creditors have been paid 87,500. There is an outflow of cash that can be recorded. Then there is a general expense paid that can be recorded. Then wages paid, cash is outflow that can be recorded. Salary paid, that also can be recorded. So these all are your operating items. So income tax paid also will come, but at the last. So when you minus from your cash inflow, you minus all your cash outflow, what happened. So you get one item. In that there is an income tax paid which is 14,000. You are minusing 14,000. And any insurance claim received, you can add that. Here there is an insurance claim around 7,500 that is added. So what you get is 46,000 under direct method. So this is cash flow statement under direct method. And next to the same question, they have given the cash flow under indirect method. Okay, so any adjustment is given. Yeah, so there is a P&L statement given where opening, sales, all it is given. And apart from that, there is additional informations are given. One is tax paid during the year 25,000. So there is an outflow. Then the opening and closing balance of debtor 24,000 and 29,000 is given. And then opening and closing balance of creditor 22 and 25,000 is given. So now this is indirect method. So what is a format under indirect method? In your net profit, when there is a net profit, you will add all your non-operating items which is debited, and you minus non-operating, you minus all non-operating income which is being credited. Okay, this is the procedure you do in your operating item. So let's see this question. Yeah, so here you can see how it goes. First we need net profit because you are finding out the value of cash inflow and outflow. So you need so here what is my net profit? Here it is given 22,000. So net profit 22,000. In this add non-operating items. So what are the non-operating items you need to add? See the question. What are the non-operating item? First is here what this all purchase is an operating item. Wages is an operating item. Salary is a non-operating item. Okay, so here what are the item? First one is depreciation. So depreciation, how much you are paying of? 12,500. So in your non-operating item, you are deducting 12,500. Then preliminary expense around 8,000. You need to add. This is a non-operating item. Provision for tax is a non-operating item. You need to record. You can see here. So preliminary expense, depreciation non-operating item, preliminary expense non-operating item, and provision for tax you have added. Now items to be deducted. Dividend from investment, anything on the credit side is it given. This sale is an operating activity, whereas dividend is a non-operating item. So dividend from non-operating item you can minus. So any item add. What is a format? One is first net profit. In this non-operating item debited, whichever got debited but not connected to, minus non-operating item which is credited. So this is what you record. Okay, so here there is a dividend from investment in the question, so that you will minus. Yes, then there is an outstanding wages. There is also outstanding salary. So this is also a non-operating item. So 5,000 rupee, another 5,000 rupee, you can, it should be deducted. Then you can see here, there is a non-operating item, outstanding wages 5,000, it has been deducted. Then because there is an increase in the liability, the format is all non-operating item added, then any increase and decrease in current asset and liability you need to record. So here we are adding outstanding wages and we are adding outstanding salary. Likewise, increase in the current asset. What are the increase in the current asset? You can see decrease, there is an increase in the debtor and the creditor, that also can be recorded. So altogether 7,500 will come increase in debtors. Then you minus that, you get the operating items from the cash flow. So income tax, how much the tax is paid in the question, the tax is paid during the year 25,000 is given. So that you minus the balance, what you get is the balance 25. This is indirect method. So here in the, this is one subdivision. It's not full portion. It is one subdivision where non-operating item are being added, which is already be debited, and you are minusing non-operating item which is credited, and then any increase in any decrease in current assets you will add it, and any other increase in current asset you need to minus. Likewise, increase in the decrease in the current liability and so on. Okay, so that is only operating item is being shown. Like here it is the entire data of cash flow statement of 3 operating, investing and financing activity is being shown here. Okay, so here there is a preparation given, the same like the previous question. You have to understand what is where there is increase and changes, and then we are recording the item. So here you can see cash from the operating item, profit during the year. So what is the current profit during the, any adjustment is given? Okay, so you can see the profit during the year, there is a P&L given. So reserve where 75 and 1,05,000, the difference you are taking as a profit for the year. I think somewhere adjustment, change in the reserve. Okay, so that has been taken as a reserve, and then you are adding all non-operating items. Here there is no other item is given, only the balance sheet is given. So any increase, decrease you need to consider. So when there is a decrease in asset, you will add, at the same time increase in liability you will add. Say if there is increase in asset, you need to minus, decrease in liability you need to minus. So this is the format. So here in this question there is a goodwill added. So let us see. First goodwill. Goodwill previous year in 19 there is 15,000, whereas in 20 there is 3,000 rupee. So there the difference is 12,000. The asset have come down, so it is been added. Next item is debtor. If you see debtor, last year it was 60,000 and the current year it is 90,000. There is increase in the asset of 30,000. So you can see it has been minus, increase in debtor 30,000. Likewise, increase in stock. So here earlier there is an asset 1,05,000, but in 20 there is a stock have increased 1,35,000. So there is a difference around 30,000 which is to be deducted. And moving to credit liability side, creditors, you can see the creditor earlier it was 60 and the liability have increased. So there is an increase in the current liability around how much? Around 30,000. So that can be added. Any liability is being increased, that is being added. And then bills payable, earlier 30 and there is increase of 1,50,000. So around 1,20,000 there is an increase in the liability you are adding. And these things assets and decrease in the outstanding. Outstanding, if you see 37,500 it was there, and then it came to 30,000, which means you have paid off around 7,500. Then it's decrease in the liabilities, so around 7,500. So when you minus this, this you prepared only using your balance sheet. So you get your cash flow from the operating items. Then the next component is investing activity. What is investing? Any fixed assets, any inflow, outflow of any of your fixed asset. So here you can see what are the fixed assets are there. Land and building is there, plant and machinery is there. So land and building in 2019 it is 3 lakh. It increased around 1,40,000, which means what? You purchased land. So there is an outflow of money, correct? The land you got it for the company, but the cash is gone out for around 1,20,000. So what you have to do? 1,20,000 you have minus because there is an outflow. That is why it has been minus. Next is machinery. Earlier it was 1,50,000 and in 2020 it is 1,95,000, which means what? There is an purchase of machinery for around 45,000 in that period. So there is a fund outflow happen. So you need to minus. Any inflow only you can add. Any outflow you need to minus. So both items are being minused. So 1,65,000. Then moving to rest, this item all are recorded here. Then moving to liability side, financing activity. So financing reserve came, was in operating item it came. So in operating activity it came. Now what are item? Share capital and debenture is there. So share capital it was 3 lakh. There is an increase, which means more shares are issued. The fund have come. So how much? Around 75,000. It should be added. So you can see here issue of shares 75,000. Now see the debenture, it was 1,50,000, but in 20 it was 1,20,000, which means the debenture have been redeemed, which has been paid off. So the cash have gone out, so around 30,000. So you can see here around 30,000. So now you minus and see what you get, the net increase of cash. So here first in operating item I have 1,24,500. Okay. Then in my investing activity, I have minus figure. So around 1,65,000 minus figure. Then in my financing activity, I have 27,000. So what is the difference you are getting? When you check, what will be the difference? 1,24,500 plus 27,000 minus 1,65,000. So how much is the difference you are getting? Cash at the beginning and the end it should be added. So what is the cash at the beginning? Around 22,500. So here you will add around 22,500. So the difference what you get, what is your cash balance? Around 27,000. So the balance what you get should be 27,000. Only then it is correct. You understood? Any doubt in this? Can we proceed with next then? So this is how we prepare a cash flow statement. So this is only with your balance sheet we have prepared the cash flow statement. So same similar model, you can try few questions. Yeah. Next. Next is cost sheet. Understanding what is different category of cost and cost sheet. So here when in the first unit we studied different types of accounting. Financial accounting, cost accounting, management accounting. In that this is also one of the part, cost sheet. Okay, now here the cost sheet helps us to study the cost of the product. So what do you mean by cost? Suppose the manufacturing of a particular item, it takes 100 rupee, means that is considered as a cost. So cost accounting will help us to study about the cost of the product, what is the cost, how much is the cost. It help us to understand those cost concepts. So that is what cost accounting does. So what is cost? It means the amount of expenditure incurred for a thing, for making a thing or for anything. What you buy. Suppose I buy some one pen. The cost of the pen is 12 rupees. So that is called as cost. So anything which you incur to get a thing, that is considered as a cost. Suppose if you have purchased a book for 150 rupee, then it can be said that the cost of book is 150. Correct? So you get a attire for around 2000 rupee. So the cost of that product is 2000. So likewise, suppose if similarly, if a manufacturer makes a table by paying 500 rupee for a timber, 200 I am paying for the carpenter for the work he does, and 100 rupee as a rent of this work. So totally the cost what I have taken from my incurred from my pocket is 500 plus 200 plus 100, which is nothing but 800. So the cost is considered as 800. So this cost is also very important for a company to study. Why means the cost is also one of the important factor which will influence the profit. Suppose if your cost is more, okay, even if your sale is high, and at the same time if your cost is high, there won't be possibility of getting profit. So it is very important to see an efficient way of having a cost. So here you will be preparing, there are various elements of cost. One is direct material. Material means the substance for which from which the product is made. So that is called nothing but your raw material. So that is called as material. Under that material you have direct material and indirect. Anything connected to the manufacture or production is called as direct material, and indirect means it is anything supporting that is called as indirect material. Example, oil, waste, printing, all these things can be considered as indirect material. Likewise, the next element is labor. Labor means a human who is putting his effort to do that process. So he is called as labor. So under labor, the laborer get a wage. There are two categories of labor, direct labor and indirect labor. So any product labor who takes direct connection to the production, then that comes under direct labor, wages. At the same time, indirect labor means salary. So that can be considered under head of indirect labor. Then expense also, direct expense, indirect expense. Any expense which are connected directly for a manufacturer, it is considered as direct expense. And indirect expense means anything indirectly supporting to the manufacturer, that is called as indirect. Example, you can see here the rent, lighting. One good example, you are incurring direct, you are manufacturing a product, so you need the light which has been in the company or in the factory, that is one indirect expense. The lighting charge is an expense. So, but that is not a direct expense, but it is an indirect expense. So, likewise, the cost is classified into three categories. One is material, labor, and expense. Under material, under labor, and expense, all three, there are two categories, direct and indirect. So, direct means which is directly supporting for production, and indirect expense means which is supporting, not indirectly supporting, which means that is also needed, but it is not the direct source for the production. That is what you call it as indirect. And overheads, there are various overheads. You have factory overheads, you have office and administrative overheads, and you have selling and distribution overheads. So in factory overheads, you can see here indirect material, indirect labor, like material means oil, consumable, stores, etc. And in indirect labor, you have salary, manager salary, indirect expenses, lighting, factory insurance, factory rent. This all will be added as a factory overhead. And when it comes to office and administrative overheads, here all indirect material like stationery items, printing, couriers, papers, dusters, all this are indirect material. Indirect labor means office manager, accountant, clerk, all these people comes under that category. And then rent, lighting, all. So again, this is all subdivided into material, labor and expense. That is considered under office or administrative overheads. And third one is selling and distribution overheads. In this also, say salary to a salesman, commission, advertisement, this all will come under selling and distribution expense. So components of total cost, there are few costs which you need to understand. These are the costs you use it for preparing a cost sheet. So the first one is prime cost. So prime cost, you add all your direct material, your direct labor and direct expense. What you get is called as prime cost. When you add all three direct components, and after getting prime cost, when you add all your indirect material, labor and other things, what you get is factory cost. From factory overheads, you add all your administration expenses. That when you add, what you get is office cost and then cost of production, which is nothing but you call it as cost of production. In that, you will add all your selling and distribution overheads, and which is called as cost of sale. You can see here. First one is prime cost. Second, from when you prepare a cost sheet, you get direct material, direct wages, direct labor. So what you get is prime cost. In this, add your factory overheads. So what you get is factory work cost. You call that as work cost. In this, add all your administration expense. So what you get is cost of production. Then in this, add all your selling expense. So what you get is your cost of sale. How will you identify profit from your cost of sale? So now you got your cost of sale. In this, minus your sale, what you get is your profit. The difference of your cost of sale and sale is profit. Suppose cost of sale and profit is given, it is easy for you to find out what is sale. So this is the procedure for preparing a cost sheet. Okay. Now let us see here. There is a cost sheet prepared. Let us prepare a cost sheet of a company showing different components of cost for 21. So there is a direct, now one by one we will do. First, what you want, you need direct material. So how much is my direct material? It is around 80,000 direct material. And what is my direct wages? My direct wages is 20,000. Then what is my direct expenses? So any direct wages to foreman. So that is my direct expense. So 4,000 rupee. So the total what you get is, which is 1,04,000 rupee. This is called as your prime cost. Okay. In this prime cost, you will add all your factory connected expense. So what are the factory connected expense we have? Now storekeeper's wages and light 2,000 rupee. Yes, then you can add that. Then wages to wages to electric power, wages to foreman, that you can add. Then what else you can add? Then wages to storekeeper, so that also you can add, 1,000 rupee you can add. So this all you will add. So what consumable store, this is added. Then lighting of factory 1,400. So that also you can add. So this not of office, only on the factory you can add. So that is factory expense. Rent of the factory you can add. That is around 4,000 rupee you can add. That is factory. Anything with the office, that will come in of administrative expenses. So those things you can add. So you can see here in the calculation how it is being done. Yeah. So all your direct you get 1,04,000, and then factory overheads you are adding. So consumable store, oil waste, wages to foreman, storekeeper, and all your factory rent, electricity. This all are been added with that. Then when you add this, what you get is your factory cost. So from this work cost, including your depreciation connected to plant and machinery. Why plant and machinery? Because that is used for production process. So you need to add depreciation on plant and machinery. Any repairs. So here there are repairs on the question also it is given. Yeah, repairs and renewals of factory, plant and machinery. So office premises you cannot take, but you can take factory, plant and machinery. So that 1,000 rupee you can add. So what you, yeah, so you get your factory cost. From factory cost, you will add all your administrative expenses. Any expenses connected to office purpose, you can add that administrative expenses. So what are the item? Indirect material, printing and stationery. So manager salary, you can see here. Director's fee, manager salary, this office expense and stationery. So this all you can, telephone charges, postage and telegrams. This all you can bring under indirect expense, that is in under administrative. If you don't categorize direct and indirect, no problem. But anything connected to office, anything connected to administration, you need to record under administration. So you will add this all under office or administration expenses. So this is added. Now what you get will be your cost of production. Now in that, what and all you have to add? You need to add all your selling expenses. So selling expense, what are there? Salesman commission, that is connected to selling expenses. Then traveling expense, because the salesman need to keep traveling for selling his product to different places. Advertisement, it is connected to sales. Yes, warehousing is connected to sale. Carriage outward is connected to sale. So this all together you add as a selling expense. So when you sell this, when you add this, you get your cost of sale. So how much it is given? Yeah, you can see here. After adding everything, selling expense on, you are getting your cost of sale. This is how you prepare a cost sheet. So I will repeat once again. In cost sheet, there are three important costs which you need to keep in mind. One is prime cost. How you get prime cost? Direct material plus direct labor plus direct cost. Direct overheads. When you get this, you get your prime cost. Now, the next cost is work cost or factory cost. Work cost, or you call it as factory cost. How will you get work cost or factory cost? From your prime cost, you add all your factory expenses. So what you get is your factory cost. From this, what you get is cost. From this, you get factory cost. In this, add all your office expense. You get your cost of production. From this, you add all your selling expense, you get cost of goods sold. This is the procedure for preparing a prime cost sheet. Any doubt in this, you can ask, or else we will move to the next. Okay, next is classification of cost. It's not very easy, quickly you can understand. I know that it will be very difficult because so much advanced we are teaching because with a limited time what is being given, but you need to prepare. That's what I always tell, because it's very, unless you don't prepare, this will be very difficult for you. So every chapter you need a few questions you can try. Say for example, in financial statement, you are preparing, studying about revenue, P&L and balance sheet. That is mandatory. You need to study. Likewise, cost sheet is one of the important chapter where you need to study about what is cost sheet. Okay. So there are different category of cost. One is basically the cost are classified as fixed variable and semi-variable. Fixed cost means the cost remains fixed over the period of time, which means now whether there is a production happens or whether there is no production happens, the fixed cost remains the stable. Say for example, rent of the building. So whether you do production, you don't do the production, the rent to be paid. So that is fixed. Yes, so there is a fixed, and even when you pay electricity bill, there is one fixed amount. It is kept fixed, right? So anything there is no change. It keeps it is default even whether there is increase or decrease. That is called as fixed expense. And then yeah, variable cost. Variable cost is it depends on the increase. When there is increase in the variable, at the same time, see, the fixed cost remains constant, which means how much ever the production take place, the cost remains the same. Example, the rent. So we are not paying a rent high when our production is increasing. The rent remains the stable. That is what you call it as fixed cost. Variable cost is not like that. The cost will vary, depends on the production. If your production is increasing, the cost will vary. You can see here, the production when it start increasing to 2000, the cost is also increasing. When it increased to 3000, the cost increased. Likewise, when it is increasing, so every number of unit, when there is an increase, there will be a simultaneous increase in the cost. That is called as variable cost. And semi-variable means it is like half fixed, not half. It is little fixed and some are variable. One example you can connect is electricity bill. So you know whether you pay or you use or not, you have to pay one minimum amount as a EB bill. After that, based on your consumption level, usage, the bill will vary, correct? So that is what semi-variable. It means what? There is one item fixed. Apart from that, it keeps increasing based on the increase in the proportion of the variable. That is what semi-variable cost. Okay. So yeah, telephone bill. Telephone bill, the minimum bill is there. This is the amount, minimum rent you pay. After that, the number, how many hours you use or how many times you use, based on that your bill will change. Electricity bill. That is all you can connect as an example of semi-variable expenses. Now you can see the question here. A company has provided the following information in respect of 10,000 units of output. Let us calculate the total cost of 12,000 units of output as per the cost. Now here a variable cost is given, fixed cost is given, semi-variable they said 50% is fixed, which means another 50% is variable. So variable fixed cost. So now they asked us to compute cost for 12,000 unit. So I am finding out the cost for 12,000. What is a variable cost? This is 50,000 for how much unit? 10,000 unit. So when you divide 50,000, when you divide 50,000 with 10,000, you can see 5 rupee, correct? 5 rupee is your variable expense. So the variable cost, so 12,000 into 5 rupee. Into 5 rupee, 60,000 is my variable expense. How I got 5 rupee? Because 50,000 divided by 10,000. So per unit is 5 rupee. So it is 60,000. Fixed cost, whether 12,000 unit or 20,000 unit, the fixed cost remains the same, which is 30,000. So 30,000 as it is. You can see this this statement is for 10,000 and this output is for 12,000. So fixed cost is same and semi-variable cost is 80,000. So how you got semi-variable cost 80,000? 50% is fixed, which means in this 50 by 100, 40,000 is fixed, correct? 40,000 is fixed. Balance 40,000, it is not fixed, it is variable. This is so you are dividing by 10,000. So 4 rupee is the variable cost for 10,000 unit. So how will you compute this? 5 rupee variable cost is over. Fixed cost 30,000. Now fixed, my 40,000 is fixed. So I written 40,000 as it is, and variable cost is how much? 4 rupee per unit. So 4 into 12,000, which means 48,000. So 88. So total, if you see, the total cost is 1,78,000. Divide with the number of units, which is 12,000. So cost per unit is 14 rupee 83 paise is a cost per unit. Okay. So this is how you compute the cost. Next is direct and indirect cost. Here there are some components, some other concept of cost concepts are given. So here one is shutdown cost. So this represents the fixed cost that has to be incurred even the factory is shut down. So there is no change in the cost. The cost remains same even if the company is not working, like rent, insurance, depreciation. This is all are considered as a shutdown cost because it remains fixed always. Next is sunk cost. So sunk cost means you cannot do with the past cost. So you got a product at 60,000. Now the cost, you are not using that product for over a period. So it is kept idle. Now you are selling that. So that is called as sunk cost. Already the cost incurred, that cost you cannot compensate with that cost. That is called as sunk. And controllable cost is the cost is influenced by your action. That is called as controllable. That is something in your hand. So usage of power at the time of production, that is in the hands of the laborers who is using. Controllable cost. Uncontrollable cost is which you cannot, it is not in your control. For example, foreman production department can control the wastage of power in his department, but he cannot control the power being wasted in the powerhouse. So something which is not in our hand, which is beyond our control, is uncontrollable cost. Suddenly there is some disease come and the entire company is shutting down. The loss or the cost incurred, that is uncontrollable. Or some strike or some monsoon change happens. So suddenly there is a change. So there is a problem in the production process. So that is all not in our hands. So that is uncontrollable cost. Then hypothetical cost. These costs that do not involve cash outlay, but for example, interest on capital, it is totally ignored because in cost we focus only on the cost area. We never consider the interest on capital. So, but it is one of the important factor which we will study about the outflow of a cash, right? So that is hypothetical cost which cannot be considered, but it also plays a vital role in that. Then opportunity cost. If you are getting one cost and you are foregoing another one, that is called as opportunity cost. For example, suppose you owned a building is proposed to be utilized for housing a new project. In that case, the revenue that building could fetch if rented out is an opportunity cost, correct? If you are using that building, if you are foregoing the rent what you are getting. So that is called as opportunity cost. And out of pocket cost. Out of pocket cost means means the present or future expenditure that it may vary. Depends on the decision. A company has its own truck for transporting raw material and finished products from one place to another. It seeks to replace these trucks by employing public carriers of goods. So in such case, the making decision, the depreciation of truck is not to be considered. However, the management must take into account the present expenditure of fuel, salary of a driver, maintenance, all these things to be considered. Then traceable and untraceable cost, which you can identify the cost, that is traceable. Untraceable, which you cannot identify because it happens in common, so that you cannot identify. Then joint cost, when two or more products produce the same raw material and the cost of material for purchasing the cost are called as joint. For example, an oil refinery. Joint cost means when you buy two or more products on out of the same material. So the cost incurred together you consider a joint cost. And conversion cost, here the transforming of direct material into production. So that is called as conversion cost. So these are the few components of cost you have. Next is absorption and marginal costing. So here we will be doing about what is absorption costing and what is marginal costing. So absorption costing is a technique. It is also called as full cost method. So here how you consider costing is you consider both fixed and variable costs. So the variable cost like direct material, direct labor. Why it is called as variable is when the laborer cost increase when there is increase of more production. The same way the raw material requirement is increased when there is increase in the production. This all are considered as raw material cost. So etc. are directly charged to the products while the fixed cost are apportioned on a suitable basis on the different products. So in absorption costing, so how we are going to compute absorption costing, we will be doing. So in absorption costing, it is in all your direct material, direct labor, all your variable overheads, all your fixed overheads, all together will be identified with the product cost. That is what you call it as absorption costing. So it is processing of tracing the variable cost of production and fixed cost of production to the product. That is what the absorption costing basically focus. In simple term, you can consider it is a costing system where it treats both fixed and variable cost as a product cost. So here in certain cost, it don't consider fixed cost. Marginal costing, if you take, it don't consider as a fixed cost is not taken. Whereas in absorption costing, we consider all both your variable and fixed cost. Okay. Now you can see there is an illustration. Tripura Limited is manufacturing 3 products ABC and the cost of manufacturing are as follows. So here it is given the manufacture of 3 different A, B, C and they asked us to the overheads direct material information is given per unit. Direct labor is given, selling price is given and the output, how much output is expected. And the total overhead is 12,000 out of which 9,000 rupee is fixed. So there is no change can be done for 9,000 9,000 rupee overhead and the rest are variable. Which means the balance is 3,000 are variable. It decided to apportion these costs over different products in the ratio of output. We would prepare a statement showing the cost of profit of each product according to the absorption costing. So what they have done, you can see here. the statement showing the cost and profit according to the absorption costing. So I told you in absorption costing, you take all your direct material, direct labor, direct product, any variable expenses, product expense, that only will determine the cost of a product. So here you can see three different units are there, A, B, C. So direct material is how much? 3000 rupee, here 3 rupee, 4 rupee, 5 rupee. And units produced, output is how much? 1000. So 1000 into 3, 3000, 1000 into 4, 4000, and 1000 into 5, 5000. Likewise, labor, 2 rupee. So 1000 into 2 and 1000 into 3, 3000, and 1000 into 4, 4000. Direct labor. And now they have said the fixed expense, 12,000 is the overhead. In that 9,000 is fixed. So 9,000 I am dividing with three different units and three different products. So every product will get 3,000 as a fixed expense. So fixed overheads you can see here 3,000 and variable is how much? Per 3,000. So I divide that with 3,000. So 1 rupee is my variable cost. So 1 rupee I am multiplying with the output what I have attained. So 1000 rupee, 1000 because the units are common. So what is my total cost for A? It is 9,000. What is the total cost for B? It is 11,000 and total cost for C is 13,000. And how much the company is selling? The company is selling at 10 rupee for A, 15 for B and 20 for C, product C. So that is that is a selling price. So selling is 15, 20, 10, 15, 20. So how much is my output? 1000 rupees. So 1000 into 10, 10,000. 15 into 10, 15,000. 20 into 10, 20,000. What is the difference? My cost minus my sales is my profit. So what is my profit? 1000 rupees. The difference between 10 and 9 is 1000. Here 15 minus 11, 4000. 20 minus 13, 7,000. So totally the 7 plus 4 plus 1. So around 12,000 is my total profit. Okay, this is where you considered all the cost. Okay, so likewise here there is another so here is another one it is given. Profit and loss of Tripura. With the given data of illustration 7.1, we would calculate the amount of profit or loss made by Tripura Limited in the first 2 years. So in the first year, the company is manufacturing 1000 units of all products ABC. Okay, but it didn't do any sales, but fails to affect any sales. In second year, it does not produce anything but sells the entire stock carried for the first year. Okay, now this is the statement of the first year. You can see first year the direct material is 3000. This is the illustration of the previous one. It is been depicted here. So A 3000, B 4000, direct material 5000. Likewise, direct material 2000, 4000, 9000 it is given. And then there is a overhead expense which is 1000 rupee every unit. So 1000, 1000, 1000 and the fixed expenses 12,000. And what is my stock? The total is 33,000. The sales have not incurred, so that is being treated as entirely as a stock. 33 is being closed as a closing stock. Now here you can see now the same P&L account you are preparing for the second year. So you can see here there is a last year closing stock become the opening stock and fixed overheads already 9,000 is being considered. And then the sale, because the last year stocks are being cleared this year. So the sale is happened for 10, 15, 20. So totally 45,000. So here basically if you see the first year profit and loss shows the first year the company does not made any sales. There is no loss, whereas it makes a profit of 3,000 rupee. But the company lost 9,000 because of the fixed cost is not being adjusted in their total. So there is a loss which has been incurred. So this is what there is a difference of marginal costing and absorption costing. Here you can see the marginal costing. When you look into marginal costing, here you don't consider the fixed cost. Here you consider only the variable cost in marginal, whereas in absorption costing you considered all the cost together. So here you can see the data, direct material, labor. The same illustration has been shown. Variable, variable cost 1 rupee, it has been taken. So the total what you get is considered as your marginal cost. In this, the selling of A was 10,000, B was 15, and C was 20. So the difference between your selling price and marginal cost you considered as contribution. Contribution is nothing but your sales minus your cost. So that is your here. What is the problem is we don't consider the fixed cost, but it is always good not only relying on absorption cost, because in absorption cost when we see the calculation wise we will never recommend we will say that the business is not working good because the 9,000 rupee all cost is considered, but it didn't adjust that 9,000 with any of the cost. Whereas if you see here, there it showed a profit of 3,000, whereas it showed a profit of 12,000. So here basically to take a management decision, you cannot rely only on one cost. So absorption cost will give a different explanation, whereas in case of marginal costing it gives a different explanation. So here the profit was showing around 3,000, whereas the same question when we do as a marginal cost, we don't take fixed cost is taken as last along with your marginal cost contribution. You are minusing your fixed cost and you are getting profit. So this kind of things will help us to take a effective decision in the company. So depends on which, just you cannot rely on one kind of costing and you have to go. So this is about that. Then yeah, so next class we'll be doing the next unit. Yeah, so thank you so much. So we'll be continuing from unit 8. So few more is there. So